Hello dear traders and welcome to Model 20. Margin and leverage explored. Trading in Forex is governed by what is known as margin and its best friend forever, leverage. So leverage means controlling a large amount of money with a much smaller amount. With leverage, traders can substantially increase the amount of money or buying power. In other words, they can trade with and enter into positions much larger than the actual amount of funds in their account. Margin is actually the minimum amount of money a trader has to deposit and have in their account to receive that leverage. You must be wondering, how does this setup help you, or how does knowing about margin and leverage help you? For one reason, if the price moves in your favor, you can end up with massively huge profits. Boom! Let's say the leverage is 1 to 500. Traders can then receive 500 times the amount of margin that they can contribute to their account. So if a trader has a margin of 50 euros, for example, they will receive 2,500 euros in leverage and be able to trade with that full amount. Now, you've opened a trade worth 2,000 euros, for example, and the price has moved in your direction and has generated a 10% profit. That would amount to 200 euros, correct? If you had originally put down the 2,000 euros and not received it from the broker via leverage, your profit would have amounted to only that 10%. Nice, but not that nice after all. However, since you only contributed 50 euros in margin and received the rest from your broker as leverage or being leveraged, your profit was actually 400%. Not shabby at all. Hence, leverage can generate larger profits for a trader. On the flip side, however, it can also lead to much greater losses if the price moves in the direction you invested against, or against the direction that you have actually thought of. To benefit from leverage, however, traders must keep in their account a minimum amount of margin, which is known as the margin requirement and is a percentage of the size of the trade to be entered, or the trade to be entered. Let's say the size of your trade is 200,000 euros and the margin requirement is 10%. In this case, your requirement margin for this specific trade would be 20,000 euros. Margin requirements vary based on the size of the trade and or the instrument being traded, of course. The formula to calculate what is your margin requirement is as follows. Now let's use an example. In a more volatile currency pair like the GBP versus the JPY, or anything involving exotic currencies, which basically excludes the US dollar, will have a larger margin requirement than the other instruments. You can always check your margin on your broker's MT4 platform under the Terminal tab. Thank you.